What's the difference between simple interest and compounding interest? We get this question a lot at Integrated Business Financing, and the answer is pretty simple, no pun intended. Simple interest, you're paying just on the original balance, right? So it's not compounding, you know the interest, and as that balance comes down, the amount of interest you're paying is going to go down and decrease as well. Versus compounding interest. Compounding interest is always going to be based on the total amount owed, right? The total amount owed at that time is going to be charged interest, and that is what you're going to be paying on. To give you a really great example of this, look at a credit card, right? A credit card, if you just make the minimum payments, right, you're going to be paying interest on top of interest. And that can put people and businesses in a lot of debt. That's why simple interest, if you were to ask me, would you prefer simple interest or compounding interest? Simple interest is safer. And the reason I say that is because most people don't pay off their credit card every month. Credit cards are great, whether it's a business credit card or a personal credit card. If you're putting everything on there, you're accumulating points, you're building up credit history, and if you pay it off its entirety at the end of the month, you're gonna save a lot of money, build credit, and more importantly, you're gonna get those points. The challenge is when people just make the minimum payment, that's when interest will compound on top of interest, and you're going to pay a lot more than what you originally took out, right? One of the things I wanna point out is if you do look at your credit card statement, they usually break it down for you, and what they'll say is, if you pay just the minimum payment, it'll take you X amount of years and you'll pay back probably like 2 times the amount that you borrowed, or maybe even up to 4 times the amount that you borrowed, depending on what the interest rate is. And then if you pay twice the minimum, it'll take, a different amount of time, but it's still a pretty long time to pay it all off. And you'll still be paying a lot of interest. They had to break that down. It was a requirement that is put on credit card statements, right? Versus a simple interest term loan. And this is the reason why a lot of people take a simple interest term loan, not just to start a business, but to consolidate credit card debt. Because what happens is that simple interest term loan, it may or may not be a cheaper interest rate. At the end of the day, that interest isn't gonna compound, which makes a big, big difference, and that's gonna allow you to save money. Not only is it gonna allow you to save money if you were to take a simple interest term loan and pay off all those credit cards, but it will probably lower the payment and it'll allow your credit score to shoot up. What are the pros and cons? Well, a simple interest term loan, you know the interest you're paying back, and if you pay it off early, the rest of the remaining interest is waived. With compounding interest, you may not have that ability to pay it off, and that interest is just going to compound. To give you another comparison, if you were to look at, credit card interest rates, a credit card, a great rate is maybe 8.99% or 9.99%, and it goes up into the mid to high 20s, and that will continue to compound. Now, if you think about it, that's what a bank is charging you, or a credit card company backed by a bank is charging you to borrow their money on a monthly basis, okay? Now, if you think and look at your bank and the bank statement, how much interest do you actually get paid from the bank? And that interest actually compounds, but it's usually 0.4%. That's why credit cards can be dangerous. If you use credit cards responsibly, they can help you build your business, they can help you establish credit, they can help you scale. Unfortunately, a lot of people get into trouble with credit cards. And if you get into trouble with credit cards, the best way to consolidate them is a simple interest term loan, and it all breaks down to that argument. What is better, simple interest or compounding interest? Well, if you are earning interest, you rather have compounding interest. Why? Because that's gonna compound, and every time you get paid, that new balance is what you're gonna get paid on. But it works the reverse if you're the one that's paying the interest, right? So simple interest kind of caps that, and either one, I just wanna make this very, very clear, either one, whether it's simple interest or compounding interest, once you pay it, there's no more interest to be paid. So once the original debt is repaid, then the interest stops. So I hope this really explained that question, because we do get it all the time at Integrated Business Financing. And if you need help getting a simple interest term loan to pay down credit cards or to start a business, please reach out and you can reach us at integratedbusinessfinancing.com. Thank you, and I look forward to working with you.